So this wasn't some minor dip. This was a financial earthquake. Pretty much out of the blue, the so-called smart money, the big global hedge funds that are supposed to be prepared for anything, they got absolutely steamrolled. They suffered their worst single day of losses in nearly a full year. The speed of it was just breathtaking, and the amount of money that vanished, well, it wiped out weeks of gains in just a few hours. Now, to really get a feel for how bad this was, you need to understand this term, drawdown. Think of it this way: you're climbing a mountain and you just hit a new record high. You're at the peak. A drawdown is the full, painful fall from that absolute peak all the way down to the bottom of the next valley. It's the most honest measure of downside risk. And on this day, the fall was just brutal. And what's really crazy is who got hit. This wasn't just one type of fund having a bad day. It was a wildfire that ripped through the entire landscape. The computer-driven systematic funds, they started dumping positions. The giant multi-strategy funds that are supposed to be diversified, they all started bleeding red at the same time. The tech-heavy stock pickers who've looked like geniuses for years, absolutely crushed. And maybe the scariest part, even the supposedly market-neutral strategies that are meant to be safe havens got caught in the crossfire. Everything went down together. It was a perfectly synchronized collapse. And this brings us right to the heart of the problem. The whole sales pitch for these billion-dollar funds is diversification. The idea that if you own a bunch of different things, you're safe. But on this day, that promise just evaporated. Everything acted like it was the same asset. The promise of diversification became the nightmare of correlation. So the biggest question we have to answer is why? And to figure that out, we have to zoom out, way out. We have to look past the daily noise and at the very foundation of the global financial system.